All right, let's talk about something every successful Canadian entrepreneur runs into: how to structure your business so you're not just working for the tax man. We're going to break down how you can lower your tax bill and, just as importantly, build a fortress around the assets you've worked so hard for. Okay, let's get right into it. It's that nagging question that can keep you up at night. Your business is doing great, sales are up, but then you see your tax return and just, wow, you wonder where it all went. Well, if you're running your business as a sole proprietor, I can tell you right now, the answer is almost certainly yes, you are. And here's the dilemma in a nutshell. As a sole proprietor, you and the business are one and the same. That means every dollar of profit is taxed at your personal rate, which can easily climb past 50%. And maybe even scarier, your personal stuff, your house, your savings, is totally exposed if the business gets sued. A corporation, though, that creates a legal wall. It gets you access to way lower tax rates and separates your business life from your personal life. So, for any growing business that wants to step away from all that risk, the first and honestly the most important strategic upgrade you can make is to incorporate. Let's really look at what that means. So, what is incorporating, really? Well, in the simplest terms, you're creating a brand new, separate legal person for your business. Think of it like that. This new person can own assets, it can enter contracts, it can get sued, and it files its very own tax returns. And it's this separation, this simple idea, that unlocks a whole new universe of financial strategy. And the benefits? They're pretty huge, and they kick in right away. First, you get those much lower corporate tax rates. You also get to defer taxes, which lets you keep more money in the company to grow it. You open up options for income splitting with family, and the list of deductible expenses gets a lot longer. But then there's the big one, the one that's all about your exit strategy. That's right, the Lifetime Capital Gains Exemption, or the LCGE. This is a game changer. It can let you sell your business one day and pay absolutely zero tax on a huge portion of the sale. We're talking savings in the hundreds of thousands of dollars. Honestly, this benefit alone is often the number one reason people choose to incorporate right from the get-go. Okay, so now let's say you're incorporated. Profits are building up inside the company, which is great. But that raises a whole new set of questions. Like, how do you get that money out for yourself efficiently? Or what if you want to be charitable? This brings us to the next level of strategy: unlocking that corporate wealth. Let's paint a picture. Your corporation invested some cash in the stock market, and hey, it did really well. Now you want to give $50,000 to a charity you believe in. The easy thing to do is just sell the stocks and donate the cash, right? Well, if you do that, you're going to trigger a capital gains tax bill. There has to be a smarter way. And there absolutely is. Just look at this comparison. On the left, if you sell first, you're hit with a $10,000 tax bill on the gain. But on the right, if you donate the stocks directly to the charity, that tax bill completely disappears. It's gone. Your actual cost to make that $50,000 donation drops by 10 grand. And then you see that row, amount added to CDA, it doubles. So what is going on there? The magic behind this strategy is really a 1-2 punch. First, you totally sidestep the tax on your investment's growth. And second, you maximize a credit that flows into a very special, very powerful account inside your corporation. And that account is called the Capital Dividend Account, or CDA. Now, this isn't a real bank account. You can't log in and check the balance. It's better to think of it like a running tally, a special tracker that your accountant manages. This notional account keeps track of all the tax-free money that is moved through your company, like, for example, the entire capital gain from that stock donation we just talked about. And here is the punchline. Whatever balance builds up in that CDA can be paid out directly to you, the owner, as a capital dividend, with zero, and I mean zero, personal tax to pay. It is one of the single best ways to pull money out of your corporation completely tax-free. Okay, so we've gone from being a sole proprietor to incorporating. We've even figured out how to pull money out tax-free. But what happens when your business gets really successful? When it starts to accumulate serious assets, cash, real estate investments? Well, for those mature businesses, there is another level of protection: the holding company. This is your fortress. I love this analogy. Think of your main business, your operating company, as a ship out there on the sometimes stormy seas of the economy. It's exposed to risks, lawsuits, creditors, you name it. A holding company is like a safe harbor, a totally protected port where you can move your most valuable treasure to keep it safe. So what is it? A holding company, or holdco, is just another corporation. But its main job is just to own things. It owns the shares of your active business, your opco, and it can own other things like investment portfolios or property. It doesn't sell products or serve customers. Its entire purpose is to hold and protect assets. So why would you go to all this trouble? Well, the reasons are incredibly strategic. The number one reason is asset protection or creditor proofing. Another huge one is that it helps purify your main company so you can still qualify for that massive lifetime capital gains exemption when you sell. It also adds a ton of flexibility for partnerships, and it's basically essential for sophisticated estate planning. And the way it works is actually quite simple, but it's brilliant. Your operating company makes a profit, but instead of letting that cash just sit there exposed to risk, you pay a dividend up to your holding company. And because one corporation owns the other, that dividend can flow between them completely tax-free. You're literally moving your money from the risky ship into the safe harbor. Whew, okay, we have covered a lot of ground here, right? From that first simple step of incorporating all the way to advanced holdco structures. Each level gives you more power, but it also adds more complexity. And that brings us to the real question. Is any of this actually right for you and your business? So let's just do a quick recap of the good stuff. When you get this right, you get a lower tax bill. You get protection for your personal and business assets. You create ways to pull out cash tax-free. You make sure you can sell your business tax-free. And you make it way, way easier to pass it on to the next generation. But, and this is a big but, it isn't all upside. Having multiple companies means higher accounting and legal fees every year. It means more paperwork, more filings. And if you don't set it up perfectly with an expert, you can actually create more tax problems for yourself. This is one area where do-it-yourself is just not an option. Ultimately, the real takeaway here is that your corporate structure isn't just some piece of paper you file once and then forget about. It's a living, breathing financial tool. And as your business gets bigger and more successful, your structure needs to evolve right along with it to protect everything you've built. The question isn't just about the structure you have today. It's about the one you're going to need tomorrow.